Welcome back. This will be our first video on a more in-depth look at monetary policy. We're breaking it up into two just because we want to sort of focus the first one more on inflation targeting and inflationary expectations, and the second piece on sort of what actually happens in the real economy due to changes in the interest rate, right? Because monetary policy is affecting nominal variables. It's affecting um, most directly interest rates, but also things like the money supply, which we'll talk about in a later video. Um, but what we really care about is the real economy, right? How much is actually being produced. And so we'll talk about that in our second video on monetary policy. All right, so just a reminder, monetary policy is in the hands of the central bank. There's a lot of similarities between different countries and sort of how that's done, but with some differences. In the United States, monetary policy, as we've discussed, is in the hands of the Federal Reserve, and there's been some significant changes over the last sort of 30 years in how monetary policy is conducted. We'll talk about some of them in this video, and then some of them we might leave until we have a more sort of detailed understanding of the banking system. All right, so our central bank in the United States, the Federal Reserve, is in charge of federal policy, and the way they're going to in charge of monetary policy, and the way they're going to do that is by changing interest rates. And so there's going to be a policy interest rate, which is sort of like the base interest rate. So in the United States, it's the rate at which banks lend each other reserves, which is short-term, low risk, and you can think of that as sort of the cost of their funds. And so when that rate goes up, other interest rates also go up. And when that rate goes down, other interest rates also go down. Now, remember that what the economy really cares about is the real interest rate. And we had the Fisher equation from before, where the real interest rate is equal to the nominal interest rate minus expected inflation. And so that expected inflation is really what we want to talk about in this video. Inflation targeting sort of came about in the 1990s when central banks realized that if they could, one, keep inflation at a low but positive level and convince the economy that that's what they should expect inflation to be, then we wouldn't get these big shifts in the Phillips curve like we had in the 70s and 80s. And so it was first adopted, I feel like it was first adopted by the New Zealand central bank, but the Federal Reserve now has also an official inflation target of 2%. And the idea behind the inflation target is that if the central bank is independent, right, and so they can make their own decisions, which has not always been the case historically and is not the case in all countries currently, but is the case mostly, then as long as inflation expectations are at 2% and inflation itself is at 2%, then we should always be at that supply side equilibrium, right? Where unemployment is equal to the NAIRU or structural unemployment. Obviously, central banks are not, all powerful, and so we are not always at the supply side equilibrium. But if inflation creeps up, the central bank can increase interest rates to try to bring it down. And if inflation is below the target, then they can decrease interest rates in order to try to bring it back up. And so it's like one number that they can focus on that hopefully will give them both of their goals of full employment and stable prices. So, why did this happen in the 90s? Well, we had sort of experienced a lot of inflation in the 70s and early 80s. And so we, in the 50s and 60s, we had this idea of the Phillips curve, but we hadn't really taken into account inflationary expectations. And so after the 70s and 80s, we realized sort of how important inflationary expectations are, and that if we could have a policy that really pegged those inflationary expectations at a low and stable value, then that would benefit the entire economy. And so that's really where these inflationary expectations came, is trying to avoid both the big increase in inflation that we saw in the 70s and 80s, but also specifically avoid the big increase in inflationary expectations. So now one issue is that the policy rate is a nominal interest rate. And so nominal interest rates can never go below zero. And so if you think about, well, why is that? Well, imagine lending someone $100. Now, with a positive interest rate, that means you'll get back the $100 plus some extra dollars in, say, a year. So if it's a 5% interest rate, you'll get $105 back in a year. If it's a 2% interest rate, you'll get $102 back. If it's a 0% interest rate, you'll just get $100 back. Well, if you have $100 right now, then there's no benefit to lending at zero interest. And obviously a negative interest rate means, all right, I'll lend you $100 now and you pay me back $98, for instance, if it's negative 2%. Nobody's going to do that because you can just hold on to the $100 and at least get 0% interest on it. So we end up with a zero lower bound. And that means that, when the central bank wants to cut interest rates, there's only so far that they can cut them. And if we care about the real interest rate, right, here's our Fisher equation. If we hit up against that zero lower bound so that the nominal interest rate is zero, then the real interest rate is going to be zero minus expected inflation. And so the lowest that the real interest rate can go is minus expected inflation. So it can be negative, right? If expected inflation, say, is 2%, then it could be negative 2%. But it can only be negative down to inflationary expectations. And so you might want a lower real interest rate than you can actually get. And so this became a problem, especially in the Great Depression. But it was also a somewhat significant problem in the Great Recession in 2008, 2009. The Federal Reserve lowered interest rates all the way to zero and then couldn't lower them any farther. Now, also, of course, you don't want deflation, because if you have deflation, then this becomes a positive number, and that just makes everything worse for the economy, because investment will decrease and the economy will be worse off. So what about long-run inflation? Well, long-run inflation, we know, right, comes from whether or not there's sort of a bargaining gap, and so we're not at our supply-side equilibrium, and sort of expected inflation. And so inflation targeting helps sort of solve that problem, because with inflation targeting, the central bank can sort of measure, inflation's being measured all the time. And so they can see, is it higher or lower than our target? If it's higher, they can increase interest rates. If it's lower, they can decrease interest rates. And if they are consistent, then we'll get stable inflationary expectations as well. So we can kind of see, right, the problems. This is really just the same graph we had in the last video, where if we get some sort of negative supply shock, then the danger is, if we stay at B, right, where we have this higher employment level, but that's no longer the supply side equilibrium, then our Phillips curve shifts up and we just end up with higher and higher inflation. And so eventually we need to shift to C. And then the question is, all right, well, do we do that where inflation is 2% still, if that's our target and the Federal Reserve does what they're supposed to do? Or do we end up at E, or even someplace higher, because the Federal Reserve waited too long? And so this graph is really just trying to show that if we have anchored expectations, then we stay on this lower Phillips curve, right? And we go from B to C. Yes, we are at a lower supply side equilibrium, but inflation is stable. Whereas if inflationary expectations become higher and we shift up that Phillips curve, now we need to have an even higher unemployment rate in order to get back to that inflation rate, right? And if we try to stay at this original supply side equilibrium, we're just going to end up getting higher and higher inflation, and that's going to be very unpopular. All right, so we'll stop there for this video. The next video will conclude Chapter 5 and think about sort of how monetary policy, which is a nominal policy, right? Nominal meaning dealing with money, dealing with interest rates, impacts the real economy.